Hello everybody, welcome to a new video here on my channel. So today I wanted to talk about a very popular pattern to trade if you're focused on price action and market structure trading. There's a lot of names for this pattern, most notably probably people that follow guys like ICT talk about this a lot, which is called the breaker. Well, that's the name he gave it. But I mean, as you're gonna see, there's nothing really new in trading most of the time. It's just patterns that we constantly see forming over and over again, and people just give their own interpretation and terminology for them. But I'm gonna break down what this breaker pattern is, which is basically just a break in market structure, and then I'll go over how we can trade this, in any market, Forex, crypto, futures, etc. Okay, if you haven't done so, make sure to subscribe to the channel, hit thumbs up, leave questions or comments. This always helps the channel grow. We're almost at 1,000 followers. Follow me on Twitter as well so you don't miss out any content. And as always, on my website, you can find all the information for my trading courses where I talk about all my strategies. I implement this pattern into a lot of my strategies. It's just a small part of everything that I use as far as my trading. So you can check those out. Okay, so let's start off first and just do a little recap of general terminology and concepts as far as market structure. So when we're looking at markets, you know that we can have uptrends, we can have downtrends, and we can have just markets that are mostly in a sideways consolidation before we get another impulsive move or another leg. So all these cycles of uptrends, downtrends, etc., they're all made up of what we call rotations, which is basically the impulse waves, which in the case of an uptrend, the impulses are going to be longer, and then we have retracements, which are going to be shorter on an uptrend. In a downtrend, it'll be the opposite. Retracements are going to be shorter, and the impulse legs are going to be longer. Okay, and then within those, price is fractal, meaning that we have the same types of behaviors repeating themselves over and over on all different kinds of time frames. So for example, if this was a daily chart here, if let's say we're looking at a daily uptrend, if we go into a lower time frame, for example here, and we look at this under a 1 hour or a 5-minute chart, we're going to have a bunch of different rotations and cycles within this on lower time frames, etc. Okay, so that's pretty much the basic concept. And when we are looking at structure, for example, if we're talking about an uptrend, well, the most basic concept of an uptrend is prices continuously making higher highs and higher lows, and meaning that the higher highs are constantly getting broken to the upside, and that's going to keep the whole momentum going, and the swing lows are going to be holding, meaning the retracements are not going to break below the previous swing lows, and then this is going to keep going. Once the market, we get to a point where price retraces and we break below a previous swing low, then this is what we would call a market structure break. And in this case, this would give us a pause that this uptrend might be finishing, and then we will look for price to retrace, and make a lower high, and then we would have the two confirmations of both the previous low being broken, and now price is hitting a resistance area and is no longer able to push upwards more. And the same thing in reverse would apply to a downtrend. Okay, so pretty much the concept of the breaker is focusing on these areas, meaning it's the last down move before price went up and broke the previous high, and then price would come down and break below this block or consolidation or demand, whatever you want to call it, this general support area here. You would expect price to come back and bounce off of this and continue. If this area, this block fails, that's then what we would then look for, a break in structure. And I'll go over the steps that we're going to take, and then you look to take trades going back into this in the opposite direction. Okay, so let's go to the diagrams I have put together for you, and let's go over the basic concept and steps that we are going to look for when trading a bullish or a bearish breaker, or upside structure break, or downside structure break, whatever you want to call it. So there's several steps that we're going to look for. This is a case of we're coming in a downtrend, or we have just sideways consolidation, or an uptrend or sideways consolidation here. But this is basically the elements we're going to look for. Step 1. We want to identify, in the case of a downtrend, a previous significant swing low that we have swept below. And now when I talk about sweeping a level basically means we traded below it and then quickly got back above the level. Meaning in this case, we broke below and then we had a strong reaction with strong buyers pushing it up quickly back again over this level here. This is giving us a possible, an indication that sellers are really trying to defend this swing level here, and this was just a fake out. So when it comes to sweeps, and I have an example here, with sweeps, there's two. Both of these examples are valid sweeps, where we have a previous swing low, price then moves, we have some movement, then price comes back, and we can either just wick below, or we can actually close below, but then get back above it very fast. In this, it's whatever time frame we're looking at. This can be a 5-minute chart, an hourly chart, daily, etc. And as always, the higher the time frame this happens, the more significant it has. But basically, what happens in a sweep is usually when we have a very significant swing low, a lot of people, let's say, that got long, they're all going to have their stop losses right below this swing low here. So when price comes back and just wicks in or breaks through and then comes back up quickly, that means all this liquidity here has been tapped. A lot of people have been stopped out, but then we quickly reverse. This is a way that big traders, it's what we call engineering liquidity. I mean, there's a lot of ways you can call this. A lot of times also, breakout traders are going to get trapped here because they see this breaking below and they just start aggressively selling and selling at the lows, thinking this is just going to continue, only for it to reverse quickly. And now we have a lot of traders that are trapped here on the wrong side. So for sweeps, this is both scenarios are valid for sweeps. Either if we see just a wick through, which this is a stronger kind of sweep because there was a quick reaction, or if we just have a break below, but then we immediately reverse back very quickly from it. Okay, then the second step on the pattern is we break through the support or resistance candles or consolidation that originated the sweep. So what we would do is, if this was just going to continue the downtrend behavior, that means price would come back and it would just come into this and reject. This is basically a supply zone, a resistance area, a bearish order block. There's a lot of different ways to call this, but basically the last up candles or consolidation before the impulsive move down. So then we expect a retracement and then price to continue with the trend. But in these scenarios, instead of rejecting, we go up and break right through this consolidation that led to the sweep. So once we identify that, then we are on alert because we know that this pattern is in the process of forming. Now, the third step is we want to see a market structure break in the opposite direction. So in this case, if this is a bullish breaker or a bullish break to the upside in trend, we want to see price break through the last significant swing high, in this case, that we had. Once we have these three ingredients together, where we had a sweep of a significant swing low, a break through the immediate supply area or the last up candles that caused the sweep, and we break the last significant swing high to the upside, meaning we're breaking now market structure up, then we go into the fourth step, which is where we're going to look for our entry, which is basically going to be price coming back into the high of the cluster or consolidation that caused the sweep, or we can also just mark a whole rectangle, the whole area of candles that basically caused the sweep, and then we look to enter a trade right here when we go back into this area. And then in this case, we would put our stop loss right below this cluster of candles, and then our targets, we would first target the previous swing high that we formed, in this case before the pullback, or if we have other important targets back here, we can also target other areas. We can trail our stop, or we could scale out here and then keep the other half for other targets, etc. That's up to you how you want to manage your trades once you're in. But the important thing is you want to get a good risk reward on your trade. And the nice thing with the breaker pattern is that it lets you have a very tight stop loss right here, and then usually you can get a good R&R risk reward on your trades. Okay, and one thing to note here on step number 3, when we talk about market structure breaks, unlike the sweeps, which we can just wick through or quickly break and come back, a market structure break, if we just sweep a level, this is not considered a market structure break. This is whatever time frame you're focused on. Let's say if you're a swing trader and you execute on the 1 hour time frame, then you want to pay attention to the 1 hour charts. We're going to see later how you can actually go down in time frames to try to refine levels, but ideally, you want to stick to your set time frame for trading. So in my case, I swing trade mostly in crypto and Forex, and I normally use the 1 hour time frame as my entry time frame. When I'm day trading futures, I'll usually go much lower because I'm just doing short-term day trades. So I'll usually use like a 5-minute or a 3 or a 1 minute chart. But in this case, for a market structure break, we want to see a solid candle close through the previous important swing low. If we just sweep this, this is a swing failure pattern. This is basically just a fake out. So this does not confirm a break in structure. So we want to see this. So meaning, if we have a swing low here and then price comes and then we just wick through and close above, this structure has not been broken to the downside. This indicates that there's strong momentum still to keep pushing up. But if we have a swing low and we break through it and close down here, then definitely, we have broken this, and now we've officially made a lower low, and now we can say we've broken the structure here. So this is just an important distinction that you want to remember, because like we said, the first step is the sweep, and then the third step is the actual structure break in the opposite direction. Okay? And so these are basically the 5 steps we're going to look for, and I'm going to go over now 5 examples in different markets and different time frames so you can see how this all plays out. So let's start off in the crypto with Bitcoin in the 1 hour chart. And we can see here, if we zoom out, we can see we've been on a strong downtrend here. We left a big gap. There's a very strong resistance level here. Right now, market is sort of rounding here. There's some accumulation here, and then we start pushing up. And then we have this here. You can see how we are trading sideways here. And then in this case, I actually didn't illustrate this example, but we can see we had the swing lows. We broke through. So then in this case, we could have even looked at this consolidation here. But the reason I would not have taken this one is because, I would like to see a more, in this case, this swing high for me is the most significant swing, and we haven't broken through it here yet. So for me, this was not such a clear bullish breaker to the upside, but up here, I do see a clear bearish breaker to the downside. And we also know that the macro trend is down. So, we know there's higher odds when playing for shorts in this case. And then we have it here. We have price coming up. We can see we're making a bullish structure now this last few days here of trading. We're going like this. You can see we are holding the swing lows. We're not breaking over any swing low except here. Right here, we broke through the swing lows. So then here, let's analyze all the steps that we talked about then over here. First step, we have it right here. We wick through. In this case, we had one wick first here, but we did not break structure here, so the pattern has not activated. But on this case, we wick through this other one, and then we sweep that level, and we came down strong. So now we have the consolidation here. This is step 2, where we identify, in this case, this was the last cluster of bearish candles before we had the move that swept the level. So now this is our breaker level basically. And you can mark the whole area, or you can just mark a line under the bottom boundary of the consolidation as I have here on this blue line, or you can just use the whole gray area. Then we came down here, and now we have step 3. We broke market structure. All the swing lows that I have with an X have been broken on this swing, on this movement down. Now we are on alert for our entry. Now we are looking for the step number 4, which is a pullback. So in this case, we are now pulling back, and we come right over here. This is our 4th step. We come back right into the consolidation that led to the sweep, and then we do the market structure break. And again, this is pure basic price action concepts. As we know, a level of support that is broken, when we pull back into it, we expect a reaction on the opposite side. This is basically the whole concept of, of why we look for a short on a breaker. In this case, we had support, 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 and we break it, and now we come back. Obviously, this whole area is going to be now resistance from the other side. And so we can see right here, we come up into here. Then we will look to enter short on this block. We put our stop loss just beyond it. And then this will be step number 5. Let's take the short tool. Let's say we enter right here. Our stop would be just beyond the cluster of bearish candles in this case. And then our target, like we said, we can first target the previous swing low before the retracement. And then we can see this 3.34. That's a really nice R&R trade. And you can see we broke and just came right to these lows. And then, we could even scale out and then target the next swing low right here. And you can see how we came and hit that as well. And you can actually see price later came again right into this level, just missed it by a little bit. And then we continued stronger down. I mean, obviously, no pattern is 100% effective. I'm just showing you examples of where we can see how this pattern worked out so you can learn to identify them. And then over here, what I was saying, you can dig down into lower time frames to try to refine these levels. So for example, if I go into a 15-minute chart, and let me just go back in time here and find this pattern where we were. Okay, so this is our 15-minute time frame. Okay, so you can see here within the 15-minute time frame, we have the sweep of the level here. Price comes down, we break below this, we break market structure down, and now on this time frame, if we zoom in here, you can see that rather than use this whole area that we were using on the hourly, on the 15-minute time frame, right here, this is the last cluster. This was the last down move that originated the sweep here. So you can see how if we go into the 15-minute time frame, then you could have even refined your entry further. And then instead of entering down here, you could have entered it a little bit higher up with a much tighter stop loss. Of course, if you refine too much a level, then, lower time frames hold less importance. And you're also, if you use super, super tight stops, some people, that's, one thing that's kind of annoying. Some people on Twitter and stuff, they share these trades with like incredible R&R trades of like 30 rewards for one risk. I mean, those are like pretty unrealistic expectations. Usually you're going to have to give your trades a little wider stop if you don't want to just get stopped out continuously. Okay, now let's go into the next example. This is in the Australian dollar, US dollar. This is a daily chart. And again, we can see all the steps right here. We had price has been coming in a downtrend for the last few months here. We can see, very clear price rotations. We're making lower lows, lower highs. And then in this case here, we come down, we sweep this previous low. And again, the more time that has passed between the last swing and the sweep, the better. Like if we have a swing low here, if we're looking at a daily chart and there's a swing low and the very next day there's a sweep, that's not as significant as a sweep like this, where we had a swing low on December 3rd and then we swept it on January 28th. There was many weeks that passed between this, so this just adds extra importance to this movement here. And then in this case, so let's just go over the steps here of the trade. We have our sweep. As soon as we got a sweep here, we identify the last candle or candles, in this case to the upside, that led to the sweep of this swing low. And we have this candle right here. So we just mark the top of it, or we can mark the whole candle in this gray box that I have here. Then you can see here how we came here, and you can see we had these two scenarios here where we broke up, came down and sort of chopped around this. Why didn't I take these trades in these areas? Because we had not really broken the last major swing high, which was here. Since I hadn't seen the last major swing high from this rotation broken to the upside, I'm still not confident to take the trade over here. I just waited out, and once we have this right here, this is our third step. Now we have broken market structure to the upside. So now this officially becomes our breaker level right here. Basically our last area of this was our resistance, which, as you can see, rejected a little but then failed. Basically a breaker, it's a failed area of support or resistance. And in this case, we can see we break market structure, and now we look for an entry coming back into, in this case, the last up candle that caused the sweep of step 1. And then in this case, the same thing. We will look for an entry right at the top of that area. Our stop loss will be just beyond the candle. In this case, we have this very significant swing, so I might probably push my stop a little bit further out just to be below the swing lows. And then in this case, where our first target would be this previous swing high, and then after that, we have this other significant swings up here, which you can see we have not closed yet. I mean, the market is closed now because it's a Saturday, but I'm pretty sure, when we open next week, we'll probably just come up and probably hit these levels and tap all this liquidity that's on top of this swing high. Okay, so that's an example on Forex on the daily chart. Let's go into another Forex pair. Let's go into Euro US dollar, and now we're looking at a 5-minute chart. And in this scenario, we have market is coming down here. We have this significant swing low, which we see we actually don't sweep this level. So we did not hit this level over here, but on this ones, we can see how we have a very clear double top right here. And then we can see on this candle right here, we sweep this previous lows here. So this is step one. Then we look for the candle or cluster of candles that led to this sweep, which in this case will be this whole cluster of green candles here. So I'm just marking the whole area plus the top of it. We break out. We break market structure here. Once we break over these two previous swing highs here. So now we've officially made, we have a low, a high, and now we've faked out. We did not break this low because, like I said, we just wicked and closed above. So this is not officially a market structure breakdown. We just swept this here. Then we push up. Now we make a higher high. So now we are expecting a pullback and to form a higher low at the breaker area. And the same scenario here. We identified the cluster. Then we look for an entry at the top of this area. And then we can target, the previous swing high. In this case, our stop loss will be just at the bottom of the cluster that caused the sweep. And then you can see we break up and then we come and it hits target and then continues in this case. Let's look at another example. Let's go into crypto. Let's look at FTM US dollar. So this is a 4-hour chart. If we zoom out here, we can see that we have some very significant swing highs here, right around the same levels. Then we have market breaks up and breaks back down. This is what I was telling you, that a sweep, it can be just a wick. If we zoom out here, like if we go into a daily chart, then let me see where we are here. Okay, on the daily chart, you can see daily candle up, and immediately we had another daily candle down. If we go on the weekly, no, where is it? Okay, right here. Well, this is the daily, but let's go into the 4-hour, which is where I'm going to focus on for the execution of this trade. So you can see we break up and come back down. In this case here, this is the break above significant previous highs, which you can see this one was over many weeks of price action that we broke above the swing highs. A lot of people probably chased the market here and then got trapped here. In this case right here, this needed to hold. This is the last down candle that caused this impulsive move that broke all the swings. So if we come back into here, we would expect a bounce and then price to just, keep doing a bullish market structure, higher highs, higher lows. However, we see that did not happen. So this is basically a failed area of support. And then we come down. So we have our step number 2, which is identifying the last down candle that caused us a sweep. Then we have here step 3, break of market structure right here. We break below, and now we can see how price comes back, and we actually came back 3 times. We try to break through this breaker here, this bearish breaker, and price just keeps failing and failing, and then it collapses. Okay, so in this case, same thing. You would have your entry at this level, your stop loss you would have just beyond it. You would have almost been stopped out in this case. I mean, if you wanted to be a lot safer, you could have put it just beyond this this other cluster here, which is the next supply resistance area above. Either way, you could have had it there, or more aggressively just above the candle here, and then you can just target, you know, previous swing lows right here, and then you can see how we came and just went over there. And then you can see how here we had higher low. This is basically like a double top, but then we had a higher low, a higher high. So this had to be a higher low here, which we did not have. And then once we have the lower low, now we're looking for a lower high, and then that's what happens. And then this is where, you know, we're coming here, lower break, and then a shallow, just a pullback, and then we just collapse here. Okay, so that's it. And then let's just look at one more example, which we have on the S&P 500. This is the 1 minute chart, so you can see this applies to any time frame. But like I said, you know, if we observe this on a 1 hour daily chart, obviously those are more significant, and then you can also drill down to try to refine your entries. And then in this case here, I have two examples of areas you could have used for this. So we have here price is, if we zoom out, you can see that the trend overall is negative for the day. We've been in a downtrend. Now price suddenly starts pulling on a pullback. If we zoom out, let's say on a 5 minute or a 15 minute, this whole area is basically like a retracement in the overall downtrend for the day. And here we have price pushing up. So we got a low, higher high, higher low, higher high, higher low. And then we have this here. We make a higher high, we break and quickly pull back down. We sweep this last level. So now here, this had to make a higher low. This whole area had to hold. This pullback should have gone like this, and then it should have just continued upwards to keep this upside momentum going here. Instead, what happened is, we have, this is the last cluster of bearish candles before the move up to sweep. We could have used this, or we could have used this wider area right here. This is what I marked both of them. But basically, this is our first step. Second step is identifying the last clusters that caused the impulse to sweep. Third step right here, clean break of market structure. We had this area of support that is broken down. So now we expect this whole support areas to become resistances from the other side. And so we can have here, step number 4, we pull back. And like I said, if we wanted to be more more refined, let's say, we could have taken this top breaker, which you can see we literally tested exactly to the tick, or we could have taken this more general area right here, this whole area here, basically all this last cluster of candles that are overlapping the last bearish candles before the sweep, and then we would have had our entry in this case under here first, but then same thing. We would take our trade and we could have either entered here with a stop just beyond the cluster consolidation, and then we could have targeted the previous swing low here. You can see the R&R on this trade wouldn't have been that amazing, but it's just 1.77. But you know, we could also target this more significant swing low right here, which we did end up hitting, and this was a nice 3 R&R, meaning 3 times the reward for the risk. Or if we would have taken the more refined method and just used this last cluster right here before the sweep and done like that, then you can see we would have had a very nice 4.13 R&R trade with a more refined level and a much tighter stop loss. Okay, so that's pretty much the summary of this pattern. So again, this is take this off. Let's just go back to this page so you can just copy this, you know, and just apply it, go over back on your charts and just analyze all the steps and just look for this pattern to help you spot potential market structure breaks and trend reversals. And again, the whole principle of this is basically a area of support or resistance that is broken after we have changed market structure, and then we're just looking for a retracement and we look for the inverse reaction from the other side. So a bullish breaker, this is failed resistance that is now turned to support, and a bearish breaker, this is failed support that now turns into resistance. Okay, so that's basically the whole principle behind this popular pattern. I hope this video has been helpful. If you haven't done so yet, please make sure to subscribe, hit the thumbs up, share with all your friends. I'm really trying to get this channel, you know, up and going with a lot more content and followers, etc., to share all this free information with all of you. Follow me on Twitter and make sure to check out my website for a lot more in-depth trading courses where I talk about this pattern and a lot more other patterns, not just in price action, but also volume profile that I use in my personal trading strategies, both intraday and for swing trading. Okay, I'll leave you all with this. Hope you have a great week, and I will see you all soon.